Welcome back, folks, to another video of the series Road to 100K through Credit Spreads. This is week 6, and what a crazy and volatile week it has been. Now, if you like volatile markets, if you like that kind of stuff up and down, make sure to hit the like button as well. Um, Actually, you really shouldn't like volatile markets because it is very tough to trade if you're not experienced, and I'm not experienced, so I'm biased on that. But click the like button anyway, please. So, um, despite this volatile week, I'd like to say that it has actually been a green week for us. We made about $70. We did 2 trades and raked in $70 of profits this week. This brings our total now from just under $1,100 to we're now sitting at $1,140. So we're finally broke into the first hundreds profit milestone. I love to see that. Um, Now our next small little step on the road is gonna be every $500. So once we hit $1,500, we can start increasing our number of contracts to 3. So every $500, we can increase that number of contracts, and it just makes our profits uh, a lot more significant. Every additional contract you put in on these credit spreads is actually a pretty big deal. So I think curve, our profits curve is going to start growing quite quickly as we hit those $500 markers. But we're just at the beginning, so it's going to be pretty flat still. But yeah, look out for when we hit that $1,500 milestone. That's going to be our first major victory, I would say. All right, let's shift gears and go into the actual trades that I did this week. So there were 2 of them that I placed. The first of which I placed on Wednesday. I actually placed a 0-day expiration trade here on Wednesday. I placed this in at about 8:30ish in the morning. A 2 contract 34.15 and 34.20 call credit spread. One of the reasons I placed it was because I woke up I think around 8ish, um, and I saw the market had already gapped up. I think it was like 40 points or so. Even though the market right now is pretty volatile, I suspected it was pretty unlikely that the market was going to go up another. How was that? It was at about 33.70 here. So for it to go up another 40, 45 points, I felt was pretty unlikely in over the next couple of hours. So that's why I put in the call credit spread. Um, and it's some of the RSI. This is the 5-day chart. The RSI was, a little high. It wasn't quite this high on some of the 20-day and 10-day charts, but I felt the 45 point call credit spread from the current price at the time of the order was very unlikely. So that's why I put it. Now, it did start to creep up a little bit, and you can see here, I think at around 11 o'clock, it was at 33.90. So it could happen. It was very unlikely. I was getting a little worried over here. I'm not gonna lie, but thank goodness the market corrected itself. Finally went back down, and we closed that for a nice little $30 gain right here. Um, so the reason why I placed this on Wednesday instead of Tuesday, like I normally would have done, I usually try to do 1-day expirations. Gives you a little bit more premium um, because of the extra day. Um, was because, well, we had a debate on Tuesday evening. I had no idea which way the market would swing, so I didn't want to get into that. I didn't know whether the market would go up or down. And in fact, if you did put in a call credit spread at the end of Tuesday, it did get, it swung like 50, almost 60 points up. So if you did a call credit spread and had like maybe a 40 point uh, buffer, you would have been a little stressed out. So I just didn't want to play it. Okay, now let's take a look at the next trade that I did. This one was on Thursday. So this one was a 1-day expiration put credit spread. 32.70, 32.65. Now I placed this at 10:30 on Thursday, and SPX needed to swing about 90 points downwards for it to hit in the money. So I thought I was safe, right? Yeah, right? I thought it was okay. Well, look what happened. As all of you know, our president has gotten tested. He tested positive for COVID, and that occurred well, when futures were trading. So if you follow futures, you can see, maybe I'll show it later after this, but you can see that there's a huge gap down. It actually started tanking, and of course, great. I put in a put Cresper right in the right time for that to happen. Um, so when it started tanking, I thought, well, great. Who could have predicted that this would have happened right on this day? I got a little worried, but thankfully Friday came and the market actually recovered quite a bit. It didn't react as badly as I had expected it to. The uh, the downward drop didn't continue. And so that's why I do, very conservative put credit spreads. 90 points. For it to swing 90 points is actually a pretty big deal. Um, so that's why I did that, and then we were able to, thankfully, let it expire, worthless, collect that premium. So a bit of a train wreck ride, uh, on Wednesday through Thursday and Friday, especially Thursday, Friday. Those futures looked absolutely crazy when the news came out. The whole world obviously was very, very surprised. A lot of people saying stuff. So that's the kind of things that you have to watch out for these put credit spreads, and um, very, very hard to predict those kind of things. That's why you want very conservative uh, margin for those. Okay, I just wanted to take a look at the E-mini S&P 500 futures chart. This is 90 days, and it's good to kind of watch these trends at a holistic level further out, just to see what you're doing, what you need to do, and what you need to watch out for when you're doing these credit spreads. So you can see here, this is the time when the market kind of tanked and started its downward trend. You can see that we were definitely going downwards, and then we actually broke out right here, and we were on an upwards trend. So that was another reason why I did that put credit spread on Thursday, because it looked like it was going to bounce off of this trend line here. But if you look here, let me zoom in. This actually broke out because this right here is precisely the time when news of our president getting COVID came out. So I wasn't expecting that. This was definitely triggered by the news. Something that I couldn't have predicted. Um, but generally speaking, all right, not all the time, but generally, these you tend to get bounces along, trend lines. So normally, when you see that, the market is gonna, bounce or hit one of these trend lines, you can be somewhat safe in doing going long or doing a put credit spread. And that's what I did. That's why I put in a put credit spread on Thursday, because I thought it was gonna, just bounce off this line. I think it was going to, but news came out. Anyway, that's just something you have to. I mean, you can't predict these things. Sometimes you get lucky, sometimes you get unlucky. The only things you can do is just making sure your credit spreads are extremely, extremely conservative. And I think that's what I'm going to be continuing to do. I might even try to go even more conservative now, because obviously our president is in the a hospital. Who knows what's going to happen Monday? The markets could tank, and right now, I think we're back into no man's land, and this next trading week is going to be extremely uh, volatile. So just going to sit back and see what it does. I may make some trades, I may not. If I don't, it's probably because I have no idea where the market's going, and just a single piece of news about this whole situation can swing the market um, extremely in one direction. So with that said, be very careful. I'm going to try to be extremely careful. And that's going to be it for this video. It was a green week, so I'm happy that happened. And if you enjoyed this video, leave a like, comment below what you think of it. And yeah, as always, thanks for accompanying me on this journey, on this long trek to 100K. Thanks, and I'll see you guys in the next weekly update.